Hi guys, welcome back to the Financial Interest YouTube channel. My name's Dan. So in this video I'm going to go over options. So we'll cover what they are and kind of go over some of the the terminology involved with them, because going into future videos I'm going to talk about how you can use options as part of a long-term strategy. But to kind of get a basic grasp of this, I'm kind of doing this video to sort of introduce the different terms associated with options. So one of the key things with options is they actually do give you a lot of options to be able to perform different things. You can actually use them to make money regardless of what the market conditions are. The market could be going up, down, or be flat, and you can still generate money from using options. But like everything, you've got to know exactly what you're doing with them, and you obviously it carries like some risks, so you need to kind of understand the risks that are associated with it as well. But let's get on with the video. So an option is a contract which gives the buyer the right, but not the obligation, to buy an underlying asset at a specific price on or before a specific date. And that's quite difficult to say. And this is kind of, we'll investigate this concept as we're going through the video, but I'll just read it back again. An option is a contract which gives the buyer the right, but not the obligation, to buy an underlying asset at a specific price on or before a specific date. So an option is a contract or agreement between two different parties. You have the buyer of the option and the seller of the option. And the options are not actually the underlying securities. It's just that they're actually derived from the securities, which is why they're also known as derivatives. And options contracts are bought and sold on an exchange. And an option is a promise to do something during a specific period of time. So now we'll look at some of the reasons why we use options. So options allow us the ability to generate profits regardless of the market conditions. The market could be go up, down, or be flat, and we can still make money. And we actually require less capital compared with buying the shares to do options trading. And they can provide the ability to use leverage. But of course, a footnote with that, you should also be careful when you're losing leverage, because although it can amplify the returns, it can also do the same with the losses. So you need to be really careful with that. And options can be bought to hedge our risk in an investment, and this is like buying insurance. And selling options can be used to get paid to enter or exit a position. And you can also use options to generate money without needing to buy or sell the underlying asset itself. So now we'll go and look at some of the key terminology relating to options. So what I'm going to do is I'll show you a few slides, and then kind of between those we'll cut to Thinkorswim, the paper trading platform, just so you can kind of see how it looks on there. So we'll go through that now. So there's two different types of options: call options and put options. So a call option gives the owner of the option the right, but not the obligation, to buy shares of stock at an agreed price on or before a specific date. And with a put option, that gives the owner of the option the right, but not the obligation, to sell shares of stock at an agreed price on or before a specific date. And here we can see just a screenshot of Thinkorswim, where we've got our calls on one side and our puts on the other. And as we mentioned, there's two things that we can do with options. We can buy them or we can sell them. So if we're buying them, we're in a long position, and if we're selling them, then we're in a short position. And we have the strike price, and this is the price at which the underlying security can be bought or sold. So here you see this is the underlying asset. In this case, we've got Texas Roadhouse, and then also the ticker symbol for that. And now here we can see the strike prices. So you can see there they go from, in the screenshot there, you can go from the strike prices from 35 going to 160. And there is also the expiration date, and this is the final date that the contract is valid. So here we can see on the screenshot we've got the expiration date, which is showing here the 18th of June 2021. So you can see it in the kind of top left and also in the middle. That's the expiry date of the contract. And this also shows the days to expiration, which in this case is 15. And next we've got the premium. And the premium is the price of the options contract in the market. So we'll see here on the screenshot we've got the premiums, and then on the left we have the premiums for the calls, and on the right we have the premiums for the puts. So here you've got the bid, the ask and the mark. So this is what the prices are to the buyer and seller, and the mark is actually the midpoint in between them. So one of the key concepts behind options is that buyers pay a premium and have rights, and sellers receive a premium and have obligations. And one options contract is actually 100 shares, and this is known as the multiplier. And this will become a bit clearer like later on when we get to an example. And now we'll just go and take a look at the options grid, because this kind of helps you to understand the concept as well. So here you can see we've got calls and puts, and we've got the buyers. So in the case of calls, the buyer has the right to buy shares, and in the case of puts, the buyer has the right to sell shares. And of course, like everything, there's always another side to it, because if someone is buying something, there is also needs to be a seller on the other side to sell it to you. So here we can see in this case of calls, a seller has the obligation to sell shares, and in puts, they have the obligation to buy shares. So now we'll continue with the terminology. So the money is actually the current market price of the underlying security. And here we can see that this is 96.19 here in the case of Texas Roadhouse. So that's the current market price, aka the money. And then we've got at the money, which is actually the closest strike price to the money. So this is, like it mentions, the closest strike price to the current market price. And then moving on, we've got in the money, and this refers to an option that's going to be profitable to the buyer if the contract is exercised or assigned now. So here you can see on the upper left side, you've got the in the money call options, and on the lower right side, you've got the in the money put options. So in the case of this call option, you can see here, in the money refers to strike prices below the current market price. And what this does is it gives us the ability to buy shares below the market price and then sell them on the open market to generate a profit. And moving on to the in the money put options, this is just the reverse really. Buying the put option gives us the right to sell shares at the strike price we choose. So in the case of put options, in the money is when the strike price is above the current market price. And this gives us the ability to sell the shares above the market price and actually buy them back lower on later to make a profit. So here we're able to make a profit by selling the stock at a price that's higher than the current market price. And moving on to out of the money, this refers to an option that is not profitable for the buyer of the contract if it's exercised or assigned now. So here we can see the out of the money call and put options. So if the contract expires and it's out of the money, then the buyer is not going to profit from the trade. But on the other side, if we're the seller, we get to keep that premium. And one of the key things when looking at options is the risk and reward. So as the buyer, we're paying for the right. So when we're buying an options contract, the most we can actually lose on that contract is the premium which we pay. And also as the buyer, our profit is going to be the difference between the market price and the strike price, less the premium which we've paid. So you'll often hear options talked about in terms of insurance, and this is kind of why it kind of helps to look at it like this as an example. So as a buyer of insurance, we're paying for a guarantee. So if you think about it in terms of car insurance, we've got our car, we pay our premium, which is usually will be for a year. And like we're paying that money out and the insurance company is like receiving that premium from us. But the risk is entirely on the insurance company, because they're the ones who are going to have to pay to fix or replace our car if anything happens. Of course, the way it works in insurance is obviously they'll be taking in millions of premiums, and obviously they need to calculate their risk, because obviously not like most of those premiums that are paid aren't going to materialize into having to repair the cars. So that's obviously the game that they need to kind of play with, weighing up the risk versus the like the cost of the premium that they're receiving for that. So as the seller of the option, the most we can actually receive is the premium from the buyer. But obviously we can take on significant losses, particularly in the case of like a call option, because there is no limit to how high the stock can actually go. So theoretically, at least, the losses could be unlimited on that. And that's because we've sold low and we have to buy back at whatever the market price is. So it could go up to like kind of any amount, although I'll have to realize that it's got to do that within the time period. So that's it for the first part of the video. I think it's better that I split it up, otherwise it's going to end really long. If you enjoyed this part, please give us a like. Also consider subscribing to the channel as well if you haven't already. I really appreciate any feedback as well in the comments. So thanks for watching, and I'll see you in the next part. Cheers.